Okay, hello everyone. Welcome to this weekend's weekly study session, April 28th, 2024. Let's start off by taking a look at the key components of market health as we do each week. Major indexes continue to hold negative. We have not seen what we would need to see to even move that to neutral, even with last week's rally, or certainly the rally we had on Friday, which I'll talk about in just a second. Up-down volume did improve. New highs, new lows, and individual stock participation are both on negative. So on balance, we're still very negative here as far as the underlying components. If we break things down a bit, we look at the Nasdaq. If we remember, going into last week or going into the previous week, actually, we saw a lot of distribution, some key distribution points within a market that was looking toppy, at least from a short to intermediate term basis. We had a rally that towards the end of that period, to the right of the chart with that little green hash mark there, that was on relatively low volume. And then, of course, we rolled over pretty hard on the Nasdaq. Distribution came into the market, into the index, and that took us to an oversold condition, which, of course, we expected to see some type of snapback, and that's precisely what's happened. We've snapped back right up into that overhead supply, if you will, and right back up near the 50-day moving average. I wouldn't be surprised even if we follow through maybe tomorrow and we see a little bit more upside. But remember, part of that was due to a big breakout in Google. NVIDIA was up pretty big. Amazon, they have a pretty heavy weighting in these indexes. So I would take that with a grain of salt, particularly seeing as we didn't see any type of volume. There was no accumulation day. That's the main thing. Volume was low, and we did not see an accumulation day. Now, even with an accumulation day or a follow-through day, whatever you want to call it, a rally within a correction or a bear market could still fail. So that's certainly not, we're not going to start jumping into stocks just because we see some type of accumulation day. Now, of course, as you know, we went short the Dow Jones via the DIA. This hasn't changed anything. We're continuing to hold that short position. We had a little bit of outperformance there, coming off the lows, and then last week some underperformance. The Nasdaq was up, but it was up 5 times what the Dow. The Dow was up less than 0.5%, while the Nasdaq was up 2%. Again, with the help of those stocks, particularly Google. Now, when you get oversold in a correction, a good size correction, you may just get a bounce from that oversold condition and then get oversold once or twice more while you go to lower lows. That was the case when we bottomed going into that October, November for that pullback that we had. I would expect this to be maybe similar in a way where we've made maybe a momentum low, but we still can make a price low. Or it's possible that, we consolidate here and we spend a little time. Obviously, it's possible we can just move higher from here, and none of those scenarios happen. But generally, what will take place, and you can see even with the Dow, we got oversold here back when we had the bear market, and that's in a pretty big decline. You can stay persistently oversold, but when you get into these more intermediate and shorter term pullbacks, you have a few thrusts down there, and that would be normal at this point. Of course, I'm prepared for either way. It doesn't. I'm not going to get caught into having an opinion and being stuck rigidly in any way. But at this point, without stock setting up, of course, it doesn't really matter. The thing I'm looking at here is the participation still. When you look at the Nasdaq, even though you had this strong rally, and a lot of people all of a sudden are saying, it's over, that's it. I had a lot of people tweet and send back to or respond to my recent tweet about how I was calling for this correction. I was short the Dow, saying, "Oh, it's over, and the low has been made," and that's possible. Maybe that's happened. But beneath the surface, when we lift up the hood and take a look at the engine, we still don't have a whole lot of horsepower there. We're still extended from the 200-day on the Nasdaq, and the percentage of stocks above the 200-day are about 40%. So 60% of the stocks in the Nasdaq are below the 200. Now, this isn't anything new. We've seen this persisting and persisting for quite some time. But again, like I I said, when you get down to 40%, especially when you get to the 30s and you're extended from the 200-day, generally it's very hard for the market to make much progress there. Certainly on the individual stock basis, and on those individual stocks, we've picked that up, of course, on the STEM model, going all the way back to April 3rd, where we went to the most cautious reading. Prior to that, we were on the orange reading, which was the sort of the middle of the road cautious reading where you could still trade, but that's where we started getting cautious as it moved from the easy dollar that we saw, a very nice period that we had coming out of that correction that we had going October and November. Um, the SPY models, of course, longer term, the long-term trend is still up. But even these models did pull in a little bit and raise a little bit of cash. The 25 model raised 25% cash, and the 33 raised 33% cash, and that was due to the moving average model, one of the components of those composite models going bearish. Again, this is one of the early strike models within those models, so that it's common for cash to be raised with one or two of the components within a correction and then go back to fully invested. So at this point, you should be 75% with the 25 model and 66.7 or 67% invested with the 33, depending on which one you follow. If you're just switching buy sell, they're still on a buy signal. We're still on that buy signal going back to November 17th and January 13th, respectively. We had a lot of sentiment, a lot of froth in the market as far as sentiment's concerned. This is the CNN greed fear index. It was way up in the greed area, and of course, I like to look at the investors' intelligence numbers, and I pointed out a week ago and a couple weeks ago how we were extreme. We're at those 60%, 62% plus bulls, and the bears did not come in at all. They were very optimistic as far as the bulls and bears readings were concerned. And I pointed out how we needed those to get closer to each other and actually hopefully across each other. So last week was a drastic improvement as far as we plunged in the bears and we plunged in the bulls, and we rised on the bearish newsletter writers. A lot have gone to the correction camp where they've said, we're not really bearish, but we think there's a correction. So longer term, similar to my read here, is where longer term I'm bullish, but shorter term a correction. So, but last week we had some actually go to the absolute bearish camp, and that's good. That's what we want to see, and we want to see more of that. That hasn't gotten to the level where, and I was going to put in the ratio, but I forgot. It's still, pretty big ratio here. So somewhere, 3-to-1 or so. So we still haven't gotten to that point where we would say that the sentiment is bullish yet. Now, longer term, I look at sentiment on a shorter term basis, intermediate, and then the real long term sentiment is looking at things like margin debt, IPOs and secondaries. I pointed this out for weeks now, or actually months, that we haven't gotten to those extreme, very excessive speculative levels in margin debt, but we have gotten to the area where we've seen corrections from, and even some bear markets. So we've come a long distance off the lows, but not to those extreme levels. Same thing with IPOs and secondaries. While we're not at extreme levels, we have come a good distance off the lows where we're seeing, on average, a lot more IPO activity and secondary offerings. So again, this is sort of mid-cycle, but the real problem at this point is that the inflation picture, or I should say the interest rate picture, has shifted or been maybe postponed, and you're seeing that in the 1 year. Now, of course, as you know, the 1 year has been my canary in the coal mine for quite some time, and I had pointed out recently that as we're moving higher here in the 1 year, and the market was starting to move with it. Prior to that, it was moving inversely. That it wasn't going to be sustainable if the 1 year kept rising, and that's precisely what's happened. And subsequent to that, of course, the probabilities for a rate cut has plummeted, and that is postponing or pushing forward this scenario where we were going to get that first rate cut. Hopefully, that we're hoping that it would happen without a recession, because when you don't have a recession and you get a rate cut, it's very bullish for the market going forward on average 12 months forward. So that was being anticipated, I think, quite widely. Now, now I think the fear is, and I think the concern for the Fed, as I pointed this out, is a reacceleration in inflation. I mean, right now we're kind of in a Goldilocks situation where, although inflation is a little bit high, maybe by certainly recent historic standards, but economy is growing and we're not overheating. Rates are actually about where they would be sort of on average or normal if you go back and you look at a long-term history. I know it feels like rates are really high, but that's just because we've gone against an exacerbated, or I should say, a very low base for quite some time due to QE. But again, a reacceleration is, I think, a real concern. I pointed this out before, how we had this in the 70s and 80s, where inflation surged and then it improved, but then we had that resurgence. Um, um, and again, this hasn't led to we haven't led to a recession here. I think the real risk, or in the Fed's mind, is a reacceleration of inflation with the labor market still tight, improving, but still tight. The PCE came out, of course, inflation is above the longer term target. It's improved, yes. Everybody's pointing out to the 3-month change and the 6-month change, and it's inflation is transitory, but it's been transitory for, I don't know, I can't even remember how many years now. It's at least 2 years. So that doesn't seem transitory to me. Years of inflation isn't transitory in my view. So again, that's pushed this sort of hopeful thinking out a bit. Um, and the volatility has come back into the market a bit here. But again, like sentiment, we're not at an extreme here. We're not at levels that we would see a real, a bottom being formed that would be significant. And we haven't cured that 100-day and 150-day without having, oh, I'm sorry, the 100% and the 150% rise in volatility that we haven't seen. You look at the 150% rise, it's the second longest that we've gone since 1989, 1990. So again, looking for more volatility here. The Nasdaq has not, historically speaking, hasn't really had a whole lot of volatility here. So this first pullback is just that. It's just a pullback, and now are we bouncing, and we're going to need more volatility to come in the market, or is it over? I personally, I think that we need more consolidation at the very least. I'm also hopeful, though, because we do have the presidential cycle, and that has a bullish 12-month forward or even greater tendency. What I was hopeful for is that we were going to get both to sort of correspond, where we get the rate cut and with no recession, and we go right into that presidential seasonal strong period, and that would really give us a lot of tailwind, or a lot of wind in the sails for, at least historically speaking, for a potential for a continued strong bull market. Half of that equation seems like it's been delayed, but I think we're in a correction within a bull market here. Shorter term, we saw some defensive areas start to spike up here, or to see some action in some of the defensive areas. You see dairy products, food dairy products went from 195 rank all the way up to 2. Now these subgroups that are ranked by IBD sometimes are just one stock has a big weighting in them. But I look to see if there's a lot of defensive areas. I don't see a big defensive move in the market at this point, but there's a little bit. And we saw also mining stocks and some mining related start to move up here. That the mining metal ores went from 173 rank into number 30. So that moved up quite a bit. And of course, as you know, in the mining, it's actually in the mining gold, silver, gems category. These groups, these IBD groups, are subdivided quite a bit. We did add this MUX, lower priced power play. Nothing, I wouldn't say get big exposure here, but again, put your toe in a few stocks here and there. That's fine with some smaller positions. Keep the exposure low, very tight, specialized entries, if you will. Another one was, of course, MU. This might have surprised you. Again, it could very easily, if the market corrects here more, it could come off and take out the lows and stop us out. I like MU from a couple standpoints. One, I know some very smart people that I talked to that fundamentally made a really good case for MU in some other areas, some of the semiconductor stocks and so forth, based on AI. And again, I see they just had a great earnings report, and this is the first pullback since then. If you take a look at MU, and I've been following this stock since all the way back to 1990s or 2000. Every time it made a new high, an all-time high, or a new high, I should say, like a 52-week high or a high after a new high after you had a big correction, it ran up but didn't have much life. It was because it's a growth cyclical. These semiconductor areas are what they call growth cyclicals. They have a growth component and they can experience big growth, but they go through cyclical phases, sort of like a with the economy, but not as heavy of a cyclical as like a paper, a steel, and things like that. So you can get these moves, but they're relatively short-lived once it becomes obvious. It kind of looks like that again here, but the difference is two things. One, AI and the driver, the fundamental driver, this is also making an all-time high. And there's only a couple of times it made an all-time high. It was after the IPO for 4 or 5 years. Here it was into 1990. I started, you know, being interested in trading MU back in the 90s. And you made that all-time high, made a big move in that big bull market. Another one here after a big correction after 95 going into 98 and then going into that blow off move, and now you're making an all-time high again. And even when it made a high and it topped over here, you had a good little run. So I think we may get at least a good swing trade out of it. The question is the Nasdaq going to come in and take it down and stop us out? We may have to re-enter on a reset. So just a small toe in the water here with a few trades. I think we got to more key in on the Russell 2000 as another canary in the coal mine, and that is for the interest rate environment, because the interest rates coming down, of course, will be bullish for the smaller caps. And they've been underperforming for a long time, and a lot of people keep talking about how small caps, small caps, small caps, but it's just not coming to fruition, at least on a relative strength basis still. Mid caps, I'm a little more bullish on. The chart looks a little better. I'm actually looking at the MDY to potentially even go back in this, looking for a setup right here to maybe go into the MDY, maybe even before I start entering into individual stocks, if the MDY can set up. And then, of course, I'm looking at the Russell 2000 also as to give me an idea of where those interest rates may go. I think that's the interest rate sensitive index at this point. And also the mega caps. The mega caps will be inverse. You'll see that shift where the money will come out of the mega caps and go into the small caps. We've seen some money come out of the mega caps here, right? We've seen some cracks in Netflix and Nvidia, of course. The question is, are these just once again pullbacks that are viable, or is there a real shift where that money's leaving and going somewhere else longer term? I think when you see the money come out of the mega caps, you got to look at the small and mid caps and see if that's outperforming before you can really make a determination that we're really making a shift here. That's a more of a secular shift. I don't see it just yet. I'm also looking at the IBD 50. This is a pullback here. We undercut these recent lows. That's great. Love that shakeout. And now we need to see it tighten up, and again, it may just go and go into new high grounds, but we're looking for stocks, individual stocks, to build those right sides. And I would think that if that is going to take place, we're going to see it in the IBD 50, and we're going to watch that also to see if we can get some consolidation here on the right side. Right now, we need some right sides to be built. If this is a pullback that's essentially run its course for the most part, maybe you get another undercut. I'm not expecting much more than I never expected more than I told you, a 5 to 8%, maybe 10 to 12% pullback. But again, with my forecast is as good as yours. I'm going to follow the stocks and buy the breakouts and set my stops and let the market dictate. Summarizing, I'm not impressed yet with what's taken place. This is a first bounce after we rolled over with the distribution. We had no follow through day, no accumulation. There's few setups. There's really not many setups here. So even if the market blasted off here and had a follow through day, it wouldn't really matter to me because there's not many stocks to buy. The other thing is the volatility and the sentiment hasn't yet gotten to those extremes, and it doesn't have to. But what it means is if we continue higher from here, and it's just back to the races here with a thin participation, well, then the upside's probably going to be limited, and we're looking at maybe even a bigger, correction in the not so distant future. We got oversold, but that can persist for a while, and it should persist. We should get a little more back and filling or another oversold condition or some diverging, or you get a momentum low and then you get a price low. And finally, of course, inflation is what everybody's trying to figure out in rates and so forth. And I think the small caps are the canary in the coal mine there, and look at the mega caps and look for that shift. I'm curious to see how these recent breaks in stocks like Nvidia and Netflix and so forth, how that's going to pan out. Remember, tops in leaders and secular leaders, they take time to build. They usually just they turn a switch and it's over. And selling happens on the way up, and you'll see that stage three starting to form. The key is to watch what's going on beneath the surface and to see what else is happening as far as in other areas. And if you're starting to get the money rotating, and like I said, small caps have underperformed for a long, long time. And at some point, you're going to get a big bull market that's going to unleash in small and mid caps. That's definitely going to happen at some point. And at some point, the mega caps will underperform. It's just a matter of, has that happened yet? Has that process started yet? I still think it's early. So we'll keep watching here. Let's see what the market brings us. I'm also looking at Bitcoin as a potential setup, forming that right side. Now you're getting that cheat, low cheat. There is some supply to the left. I'd be a little careful with it because it's widely followed. It's more like a commodity. It's not like an individual stock that doesn't have a lot of eyes on it. Lots of eyes on Bitcoin. So you're going to get more random price activity, more likelihood of getting whipped around and stopped if you're going into supply. But those are the areas I'm looking at right now. And I have not done my stock work